Welcome, everybody. Great to see everybody again. Welcome to the Savvy Investor YouTube channel on our Savvy Investor Raising Capital Investor series. And we are now getting into day 3 of our series. So for those that are brand new to Savvy Investor and our YouTube channel, my name is Mike Ponte. I'm the founder of Savvy Investor and longtime Canadian real estate investor. So welcome everybody that's joining us for the first time. So it's been an interesting couple of days. We've had some great topics that we've kind of shared, and this is done in sequential order to help support you. And today, again, day 3 of today's Raising Capital Investor series. And today we're going to be tackling about structuring your joint venture partnerships. So we've talked about building trust and credibility and all that wonderful stuff today. Today is all about structure. And this is going to be kind of interesting. We are really going to break down the roles that we discussed yesterday and over the last couple of days, and really take it down to more of a financial perspective. And so for those that have been raising capital in the past, this can be a struggling challenge for a lot of people because we're talking about that wonderful 50-50 split. And sometimes people tend to get stuck in this scenario. If that's you, don't be afraid. We've all been through that. And that's what we're going to be breaking down in today's session as well. And then more importantly, for our money partners that are watching this and are part of this process, and they're like, you know what, I am looking for real estate investment experts, and I don't necessarily know what to look for, and I am struggling with this whole 50-50 split. That's what we are going to be talking about. It's all about understanding the work that tends to kind of come along with acquiring properties. But like we talked about yesterday, it's really about creating that win-win relationship where everybody is achieving that common goal for each other. We're trying to reference that. And that has been the series all the way from the very beginning, is how do we bring in each other's resources, the capital and also experience and knowledge, and make it be a cohesive structure to make it be a win-win for everybody. Okay. So as mentioned kind of a little bit yesterday, if you've missed the last couple of sessions, make sure to check it out on our YouTube channel and make sure you get it all and play a little bit of catch up if you haven't, because we've been breaking it up in this sequential order for everybody. We couldn't do it all in one day. It would have been a very long day for everybody. So we've broken it down in 4 increments to really help kind of create that step-by-step approach for everybody. Okay. So if you missed it, just go to our YouTube channel. Make sure you just watch up, play a little bit of catch up, because as of tomorrow, we are bringing all of this together to make it a little bit cohesive and to make it a really clear structure for everybody that's wanting to do this. Okay. So with that being said, and it's a reminder for everybody, if you've got comments, questions whatsoever, please post them in the comment section. I can see them very clearly and happy to answer any questions that you have as we kind of go through this. And even for those that are watching the recording, post to your heart's content. I will do my part to make sure that I respond accordingly as well. Okay, to kind of help things get started here, I'm going to also do a little bit of friendly reminder. If you haven't had the opportunity yet, and again, we appreciate your constant support, please take a moment to subscribe to our YouTube channel. We really, really appreciate this as we try to continue to grow and expand it. It's been great for the last couple of days as we've been able to grow. In addition, for those that have subscribed, also, please take a look and go to our website. It's a brand new website. We've got lots of great resources to help support you, lots of great free tools, and again, things that we've got there to help provide some guidance to help support our savvy investors as well. And it's at thesavvyinvestor.ca. So with that being said, let's kind of get to the topic at hand. As you're joining us, say hello to me. Let me know where you guys are calling from. Love to see everybody's smiling faces here. It's always wonderful to see everybody. So let's get to the topic and let's get right to the presentation. So this is kind of what we've highlighted so far as part of our dialogue for the first couple of days. Well, just bear with me here. There we go. Perfect. So we talked about how a joint venture partnership works, the pros and cons that go along with this, because it's really, really important to understand before you get in, what are some of the good things and what are some of the bad things that we should take into consideration before jumping into a potential joint venture partnership. Yesterday, we talked about how to find those joint venture partners. Where are they? And more importantly, how to present to potential joint venture partners. And we kind of shared kind of a more of a script format to help support you guys. So again, just kind of follow that along. It does help provide some clarity in your structure and your presentation. You'll have a lot more success if you just kind of follow it from that process. So today we've kind of highlighted, a couple of days, pros and cons, how to present, how to find partners. Now it's all about structure. What are we needing to do to structure this partnership to make it kind of that win-win scenario that we've talked about. Okay, so that's what today's session is. Really looking forward to this. And I shared with you guys all yesterday, this one's a tough one sometimes for people that are maybe raising capital. And just show of hands, has anybody had any issues maybe trying to raise capital or talk about that 50-50 split? If you have, just raise your hand or say, yes, that's me, because you know what? You're not alone. It's always tough, but this is going to go into much more detail to help support you guys as you go through that and hopefully help you overcome that objection as well. Okay. So with that being said, today's all about structuring your joint venture partnerships. As I referenced before, and you will be hearing this for the next couple of days, it is really about the legality side of things. So again, a little bit of a disclaimer that I do want to make sure everybody's clear of. Before raising capital, please take a moment, get some legal advice in advance before you structure any potential joint venture partnership. You should, as a money partner or real estate expert, please just make sure you have some of that dialogue with your lawyers just to make sure everything is crystal clear. The content that's being shared is really based on a lot of my experiences and knowledge that I've learned over the last several years, but it absolutely does not substitute legal advice before pursuing. So that is just the caveat that I put in there and just a little bit of a legal disclaimer. But at the same time, happy to answer any questions as you guys proceed accordingly. Okay, so let's get right to the topic. Okay, and really this is the goal, folks, is how to create this and how to structure this win-win relationship that we've been kind of talking about for the last couple of days. And this really is the goal of the entire series, is how do we collaborate? How do we bring these resources together with the intent that everybody's successful? And again, one person's got the capital, the other person's got the experience and knowledge. We collaborate, and at the end of the day, we all work together, and by working together, there's a lot more success, okay? So with that being said, when you do this collaboration, people tend to grow much faster than an individual just trying to do this on their own. So imagine us real estate experts that have been doing this for a while. Imagine not raising money from a different source. How long it would take for you to save all your money for a down payment to buy your next property? Like, how long would that take to kind of accomplish the goals that you've set for yourself? It's probably going to take an extremely long time. Okay. And so that's the key, is for real estate experts, it's a no-brainer. Just like, I've only got a certain amount of capital. I really want to grow and scale, and I kind of want to follow what other people have had success with, and that's raising capital to escalate this a lot faster. Now, for you money partners, you got to really think about this. And I think for a lot of people that got started, myself included, I'm like, you know what? Do I really want to use my money to partner with somebody else when I can do this myself? But with that comes all the time and energy and effort to educate yourself versus someone else already committing a lot of that time already. Okay, they've gone in and maybe spent thousands and thousands of dollars in education. Secondly, they have actually got experience, and it may have been years and years of experience and knowledge combined that you as a money partner do not have. So is time on your side? That's the million-dollar question. And are you willing to take that time to learn first before you venture off? Not to only to mention for those real estate experts that have been in the trade for a long time and have learned from a lot of maybe costly mistakes that you don't necessarily need to learn from. So that's really some of the benefits that comes with this whole collaboration thought process. And it is important to understand, as some people will want to do this on their own. And there really is nothing wrong with that. But what I have found is by partnering together, you actually grow faster together. Okay. So with that being said, I think one of the best ways to maybe provide an example of maybe what a scenario looks like. Because it happens, joint venturing and raising capital and partnerships is a very common occurrence in the business community, and especially so on the real estate side. So let me just kind of give you a little bit of an analogy of an example of what can happen out there and maybe provide a little bit of substance to kind of a typical business structure. So let me introduce you to Susan. Okay. So Susan is an executive chef with a major hotel, and she is extremely highly recognized and very experienced. Let's say she's got 15 years worth of chefing experience in the industry. You know, she understands all aspects when it comes to restaurateuring, when it comes to back of the house, which means running the kitchen very well, also the front of house, working with bussers and all of that stuff, and also just the overall management of the business and profitability. She understands this, okay? So she has a very good, solid relationship with her team. She's got a very solid team of individuals, and she always knows if she is looking for somebody new, she can always tap into her relationships to find somebody to fulfill that spot, to help her continue to be successful in her business. Now, here's the thing. She is working for a hotel, but she has a dream. She has a passion. There's something that she's always wanted to do since she was a little girl. I'll let you take a guess and post on the comments. Take a wild guess what she's always dreamed of wanting to do in her career, okay? So I'll let you take a quick guess, but if the answer is this, she's always had that vision. She's always wanted to own her own restaurant. That's always been her goal. That's always been her vision. She's always wanted something to do. She's always wanted to do this to see if she can be successful on her own and take a lot of that experience and knowledge and really put this out there and make this thing happen. Good for her. She's got that knowledge, but she's got a problem. I'll let you take a guess what the problem is. What is her problem? Post it in the comments. What do you think is the one problem she has? And if you guessed it, she has no money, honey. And that's the biggest problem. She has no money. She has a lot of passion, and she has a lot of confidence, and she has a lot of knowledge and a lot of experience. And she's just so available in regards to being successful. Her issue is, I just don't have any of this. And this is where some of the biggest issue is. Now, if only she had money to pursue her passion, and more importantly, be able to make the profits that she's making for the hotel, but keep it herself. If there was only a way to do that, what is she going to do in this particular situation? So let me introduce you to George. Okay. So George here is a frequent diner at Susan's hotel. Okay. He has built a great relationship with her. He's got to know her over the years. And you know what? He has a lot of confidence in Susan and knows Susan quite well and absolutely loves Susan's food. Okay. George is a venture capitalist. And for those that don't know, he is an investor. And for him, he is always looking for new projects to invest in with the purposes of making a good return on his investment. So that's always his thing. That's his shtick. And that's what his passion is he's into the investment world. He's trying to make a better life for himself or better returns on his investment. So good old Susan here knows George, and obviously they've talked, and Susan's brought up the idea of possibly opening up her own restaurant, but she's got an issue and she doesn't have the capital to facilitate this. And that's been the biggest problem. So George, being very kind and knowing Susan very well based on her experience and her knowledge, he has a little bit of confidence in this idea and is actually happy to invest in the project, invest in this idea. Okay. So here we go. George puts in the money, and for the most part, he is a silent partner in this situation. Okay. So Susan's running all the operation of the business, and George is providing the capital to actually support this project. And this is where they win together. Okay. So again, Susan does all the work. And at the end of the day, they split the profits 50-50. They're all committed two different types of resources. One is capital resources. The other one is experience, knowledge, and time. And they pool together. And at the end of the day, they split the profits 50-50. So what do you guys think? Is that a fair arrangement? Susan doing all of the work, spending all the time, coming up with ideas, managing the business, where George is actually doing, is really more of the silent partner. But at the end of the day, they both profit together. So, and I think for a lot of people, when you hear it from this perspective and not take it from a real estate perspective, in a lot of cases, you may kind of feel like, hey, Susan's getting a little short change. She's doing all the work. I don't see George doing any dishes. Thank you very much. So why is he getting that 50% split? And so that's the $1 million question. It is got to be a fair arrangement between both sides. But again, Susan would never have been able to live her dream if it wasn't for George. So by coming together, they're supporting each other, and they're both getting out of it what they were hoping to. And that's really the end game. This happens all the time in the business community, all the time. Okay, so let's take a look at this in some more detail and let's understand it from the money partner's perspective. Okay, so first and foremost, when you look at the money partner's perspective, they're looking at it from this, or they should be looking at it from this way, is technically they're investing in a project and they're getting free labor out of this thing because Susan's the one that's actually doing a lot of the work. Okay, in our situation, when it comes to real estate investing, it's us as real estate experts that are doing that. George, or the money partner, doesn't have to be has no management responsibilities whatsoever. If there's anything to do with vacancies or tenants or renovations, that is the responsibility of the real estate expert to manage that stuff. Okay. At the end of the day, the real estate expert has all the experience, the knowledge in their field, and has hopefully access to quality properties. So again, they've built their investment team. They have been able to connect and engage and network. They're coming to sessions like this where they're constantly learning and improving, where George is maybe not necessarily doing the same thing. So for me, for the money partner, they don't necessarily need to do any of that work, which just saves them a ton of time. And at the end of the day, they're getting good returns, and hopefully better returns than your conventional investment structure. The best part about this is they're part of this arrangement. They're profit sharing in this situation. The money partner doesn't really have to do anything whatsoever, but it does provide a benefit for the money partner, and they can have confidence that their investment's going to do well. So these are, from the money partner's perspective of a joint venture, these are some of the serious benefits that really come along with this. And it works out very, very well. Is I invest my capital. I don't have to do any of the work, spend any energy. I don't have to do any training. I don't have to do any of that stuff. I don't have to deal with tenants, but I do get a good return on my investment. Sounds pretty good, right? So let's take a look at it from the real estate expert's perspective now, okay? So from the real estate expert's perspective, it kind of looks a little bit like this, okay? The real estate expert doesn't have any capital, but they want to continue to pursue and grow and expand, which is awesome, right? But what their resource is a lot of the sweat equity that comes along with this, okay? So they are responsible for the acquisition, managing properties, managing property managers. They're dealing with tenants and renovations and all that stuff. And more importantly is they've also got to keep their finger on the pulse, especially with what's going on in the economy and the market. Tomorrow, we've got a very big announcement, okay, in regards to interest rates. For a lot of real estate experts, they should be keeping very, very close eye on this and how this is impacting their overall business and how it's going to impact the joint venture partnership as well. And again, this is talking about more management, which we'll talk more about tomorrow, okay? But again, the option here for the real estate expert is they can actually participate in multiple quality investment opportunities. They put in all the sweat equity, but none of the capital that comes along with this. So for them, they're committing and they're investing their time, their energy, and all their efforts in exchange to be participating in a project where they profit share together. And again, this is what creates that kind of whole win-win scenario between both sides, where everybody's getting what they're wanting to get out of this thing to make it successful. So again, this is the perspective of the real estate expert. The money partner doesn't have to do any of this work. And by collaborating together, they get exactly what they're hoping to accomplish. So when we look at the duties from kind of Susan and George, Susan, again, she's doing all the cooking, doing all the cleaning. She's managing the front of the house, the back of the house, managing all the books, all of that kind of stuff. And with that, she also has to communicate to George, who is the money partner, where for him, all he's providing is the capital and just being available to have those financial reviews with Susan, because they are business partners in this venture together. The same thing applies in this real estate world. And you guys have seen this slide already once before in the previous session, okay? As a money partner, they provide the capital. At the end of the day, they're hopefully going to be receiving cash flow checks every single quarter or semi-annually or annually based on the structure that you have. And then more importantly is being provided market updates of what's going on. So I would imagine for a lot of real estate experts over the next week, they will be talking with a lot of their money partners to say, hey, we've seen a major increase and this is how it's going to impact our numbers. That's the arrangement. So the money partner, for the most part, does not need to be involved in the day-to-day operations whatsoever. And that's the way the structure is. For the real estate expert, well, as you can see, there's a lot of boxes on the right-hand side. You got to do the acquisition. You got to make sure you do your due diligence. You got to go through the inspection process, property analysis. You got to go and find your investment team, put together your investment package. You got to do your due diligence on the property, and just so on and so on and so on. All the tasks that are needing to be done to make this successful. This is why you get paid the big bucks, kids. It's like you've got to be able to provide that support, show your experience, show your knowledge, and show all the time, all the energy that you spent in your education to help provide support to ensure that this investment is going to work well, because you're building confidence to your real estate, to your money partner, that investing in you was the right investment. And that's the real key to this. Okay. So with that being said, this is kind of that typical structure that people need to understand. So let me ask you, did George invest in a restaurant, or did George invest in Susan? Okay. So I want to take that step back. Did George invest in the restaurant, or did George invest in Susan? So post that question. Let me see what you guys come back with, because it reinforces kind of the discussion that we talked about literally a day ago, okay, in regards to what is it that you are actually selling, okay? And if you answered the question that George invested in Susan, you're absolutely right. That's what George invested in. George has built that relationship with Susan. George had confidence in Susan, in their knowledge, their expertise. It wasn't the restaurant, and the same principle applies here as well. It really is about trust and trust, and that's the biggest piece. So with this being said, this is kind of your typical structure that tends to happen. And so when it comes to the real estate structure and how it's split from a numbers perspective, it tends to look a little bit like this, okay? So this is kind of your standard real estate structure, okay? So when you are investing in more of a single family property, and this is what we're talking about today, the investment capital and the mortgage qualification, again, this would be the George, would be coming from the money partner. So their job is to provide capital, and in most cases, they will also be qualifying for the mortgage. That is the responsibility of the money partner. Now, in regards to the real estate expert, their job is to secure the property, make sure that it's being managed appropriately, and finding good quality properties, so to make this a successful venture for both sides. Now, how the profits are split. So anything that is gained on the equity earned, so any equity that has been generated from the property that is based on appreciation or even mortgage pay down, that is technically split 50-50. Okay, so that's a very common occurrence. All the equity is split. Now, even the profits that come from this, which means the net cash flow. So after the rental income and after all the expenses, there is something called cash flow at the very, very end. That is normally split 50-50. So comes the equity gain and then also the cash flow. That is normal occurrence to be 50-50. Okay. Now here's the other side. When the time comes that you're about to sell this property, that is the arrangement. You guys are splitting the profits of this property, usually 50-50. Now, in some cases, depending on your structure, and again, it depends on how confident you are in your investment, you may also be responsible for the liability 50-50. So be aware of that. If this is something that is very, very common, so you got to be really, really clear about this, is what's the profit and what happens in a situation of a liability. Let's say you lose $10,000 on this deal. Are you willing to accept partial liability to this of 50-50 equally the same way as the profit? In a lot of cases, that is the answer, and that's what normally tends to happen. So just be aware of that. Is you got to have confidence, Mr. Real Estate Expert, that your investment is going to do well to make this kind of that harmonious relationship that you guys are both striving for to make it successful from both ends. Okay. So with that being said, what you guys are going to be looking at is this, is you're trying to kind of come together, and this is the name of the game. It is really about having this relationship, getting those resources together to create this win-win, even with the 50-50 split. So we talk 50-50. And for those that are watching, they're just like 50-50 split on the profits. Remember, the real estate expert, Susan. Susan is the one that's managing all the details of the property. The money partner is not doing anything. And so when it comes to the real estate side, I always challenge a lot of our money partners. And this is a question for you real estate experts to ask your money partners is, what type of return are you looking for? And if you are looking for like a 10% return on your investment, Mr. Money Partner, and you're able to achieve that after a 50-50 split, you're still hitting your objective. So it really doesn't matter how much I'm making. The focus for you money partners is after the split, are you comfortable with the returns that you are making? And that's your answer, is not to be worried about what the real estate expert is making. It's, am I happy with the returns I'm making after the 50-50 split? So let's kind of break down an opportunity or an investment and look at some actual numbers of a property. How's that sound? Okay, so I'm just going to expand on this real quickly here for myself so I can see it a little bit better. Okay, so this is a property. Let's just say this is a 3-bedroom property in Edmonton. So this is actually a real deal. Okay, real deal. And so this is a property. The value of this thing, the asking price from the seller is $204,000. Okay, appraised value is coming in at $197,000, and the total investment on this thing is $47,000. Okay, and just so you know, this 3-bedroom, 1.5 bath townhome, for those that are in Toronto and in Vancouver, these prices actually do exist out there. So you can buy a townhouse like this for under $200,000, which is crazy, right? So with that being said, let's just say we purchased this, and we were very fortunate to buy this maybe below what the appraised value is, and we got it for about $185,000. This is kind of the way I model my investments. And so for me, I always like a little bit of equity at the very beginning. And this is what the situation is here. Okay. Now, let's just say we've made some equity of the property, roughly around $12,000. And let's just say that this property is also generating cash flow of roughly $300 a month. Okay, perfect. That's great. Not unrealistic out in that market, just so you guys are well aware. These are kind of the prices. These are looking for the down payments, and cash flow can be within that range as well. Maybe today, tomorrow might be a different number as we see those interest rates go up again tomorrow. So we'll see. So with that being said, let's just take a look at this in a little bit more. So let's just say we are looking to buy this property, and we're working with the money partner. We need $47,000. And so our money partners says, you know what, Mike, I'm interested in doing this thing. And I've got $47,000 in my home equity line of credit. So let me use that. Okay. So with the line of credit payments, okay, the money partner's investment. So currently they're paying $115.54 times 36 months. So their current payments that they've made is $4,159.44. So that is the responsibility of the money partner. They are making those payments if they're using their line of credit. Okay. So based on the profit that we've made over the duration of time, okay, let's just say we've held this property for 3 years as I've referenced above. So equity again from day one, we've made $12,000. Fantastic. Okay. We've got equity from the very beginning. We've also got mortgage pay down of just under $11,000 as well. So we've paid down the mortgage over 3 years. Fantastic. In addition, we've generated roughly $10,800 a month, or $10,800 for the duration of the term of 3 years of cash flow. So combining all three of these, we've made $33,770. Fantastic. That looks awesome, right? So let's break it down from an investment perspective with the split with the money partner. Okay. So we've seen this. Let's just say, okay, this is based on equity pay down. This is based on equity from day one, mortgage pay down from day two, or mortgage pay down for the 3-year term after over 3 years, cash flow as well. And then let's just say that the property appreciated at 2% per year, only 2. I always like to stay conservative. Okay. And let's just say that appreciation was an additional $7,958. So we forecasted our profit at $41,058. Okay. So let's look at how the split works based on the 50-50 split. Based on the equity side, we split that 50-50. So the money partner gets $6,000, the real estate expert $6,000. Mortgage pay down, same thing, $5,485 for the money partner, $5,485 for the real estate expert. Cash flow, $5,400, $5,400. You guys are getting me here, okay? Now, profit per partner so far without the appreciation is $16,885. Now we include the depreciation. So now we've got extra. So we split that as well. So it's another $4,000. So the total profit per partner, okay, after all of this split is $20,864. I hope everybody's following me here, okay? So mortgage pay down, equity from day one, and cash flow plus appreciation. So far we're doing pretty good. So with the returns for our money partner is making a return on investment of roughly 36% or 12% per year. So that's the answer to our money partners. It's not so much what our real estate expert is making, it's what you are making. And are you comfortable with that particular profit? Okay. So with that being said, that's the returns. That's what we're looking at. Okay. Now for the real estate expert, okay, we're seeing them as an infinite return. So that's a real key thing. So because they're not put any money into this whatsoever, what they have generated is they generated a really good return just based on their time, energy, and effort. Okay, so just be aware of that. So it looks like a little bit of a little discrepancy here at this 14%. So disregard that. So I apologize. But the whole point of this is structure. So I just want you guys to understand that. Okay. So with that being said, let's take another look at this, because one of the comments that I tend to get sometimes is this investment of $47,000 is from a line of credit. So it's not necessarily a true investment. The only investment that has been issued is actually the money that they've paid in the interest portion. So I will post that out there as well. I like to calculate the full $47,000, but for us real estate experts, this is another way to kind of consider and look at this. So we see here as an investment required $47,000. Okay. They use the line of credit. These numbers are all exactly the same. So the total capital investment from our money partners, truly, this is what they've paid out. This money is actually just coming from the bank. Okay. But this is really what the payments are that the money partner's putting in is $4,159.44. Okay. So with that being said, that's what their initial investment is. So if we break down those numbers a little bit further, all the profits, all of that is actually the same. The only difference is the actual investment amount was $4,159.44. So when we look at it from that perspective, the money partner is actually making a significantly more or bigger return on their investment. And again, disregard the second line. I'm going to reference the top line. I apologize, just a little discrepancy that's in the slide. But with that being said, it's 135% return per year or 406% over a 3-year time frame. And again, the real estate experts ROI is exactly the same. Okay. So for me, there's two ways to kind of spin this thing, to be honest with you, but regardless, I always like to use the full amount, that $47,000, because that is still the money partner's money. But again, I've seen people do it in this fashion as well. And I know when I've presented this in the past, people are like, well, Mike, the only number that's really truly there is the $4,159. So I've spun it and kind of do two different ways. But for our money partners, what's really, really key for you guys is asking the question, does this fit my investment goals? Yes or no? Yes, you can spend this at 135% per year as a return on investment, or I can go take a couple steps back and say 12% per year. And if that is a good return on your investment and better than what you're able to get out on the trade and out on the market from your mutual funds and stocks, it doesn't really matter what your real estate expert's making. Are you happy with your returns after the split? And that's the real questions that you've got to ask. There is time, there is energy, there is effort, and there's lots of work that kind of comes along with this game called real estate investing. And so for the real estate experts, it's really, really important to understand, make sure that you're getting your value as well in this whole situation. So just be really clear with that. Okay. So with that being said, let me just kind of flip a few slides here. These are two different ways to kind of structure this in your deal, but there are other ways to structure your investment deal. And so you can do other things other than just a basic 50-50 split. And so let's kind of just do a quick review of that for everybody. And it kind of looks like this. Now, with this part of it, there are other ways to kind of facilitate this. You can look at this as a 50-50 split. But if you are working with more than one partner, then with that being said, you can split this 50% to the real estate expert, 25% to one of the money partners and 25% to the other money partners. Okay. So these are just a few different ways. Now, say, for example, the real estate expert is actually putting capital in the structure, capital in the deal. And also the money partner is putting capital in the deal as well. But maybe the money partner is qualifying for the mortgage, but you are putting money into it. Typical structure tends to look more like 60-40. That's a kind of a common theme that I tend to see. Okay. In some cases, what if the real estate experts got the money? Okay. But they actually can't qualify for the mortgage. So as a real estate expert, you've got the money to do this. You've got the experience and the knowledge, but your debt service is too high and you're looking for somebody to kind of help support you to kind of facilitate that. Well, this is kind of a structure that does happen. It is about 70-30 split. And so with that being said, that's another option for you real estate experts that have the money, but actually don't have the capability to proceed with this. Okay. With that being said, also, the most common one that you tend to see is the one that was just recently presented to you, is this whole 50-50 split. Okay. These are just a few different scenarios, but there's so many ways to do this. I want to be very, very clear. Multiple different ways. And so with that being said, there's a lot of reasons why people would go off the 50-50 split. And here's just kind of a few to kind of highlight. Okay. So again, why would we consider variations to a joint venture structure? First of all, capital investment, possibly sharing responsibility. Maybe there's actually two real estate experts that are part of this transaction. And both real estate experts are looking to split some of the duties, maybe splitting some of the profits. And maybe one person is living in a specific area. So maybe one partner is living in Edmonton, the other one's living in Vancouver. Well, the person working in Edmonton may be responsible for property management, overseeing the property, and doing a few other things, where the money partner in Vancouver or the real estate expert in Vancouver may be doing all the bookkeeping and other things as well. So again, understand your roles. And we talked about that even yesterday. What are the roles? What are the responsibilities? Because this will actually put some things into place in regards to how the structure needs to be split. Some people change their structure because they're sharing on some of the sweat equity, like truly doing some of the renovation work in the property. If you guys are doing a burr or flip, very similar scenario. You've got a money partner or real estate expert in Edmonton, and he or she is actually doing some of the renovation work, saving some of the expenses. But again, the joint venture partner in Vancouver is doing the books. There could be some different structures that are there. Okay, maybe there's a lack of experience giving more equity to the money partner. Okay, so with that being said, just understand that if you as a real estate expert don't have as much experience, maybe you want to structure this a little bit differently to the money partner. Okay, maybe the real estate expert is actually doing the property management as well. So in this scenario here, if the real estate expert is doing property management, maybe the real estate expert deserves a little bit more percentage ownership than just in lieu of a property management fee. Okay. In addition to that, there could be multiple different partners in a situation and multiple different roles. So there's lots of reasons why this structure can be skewed in so many different ways. And there's just so many different ways. There's no common rule of thumb. 50-50 tends to be it. But the important part is that all parties agree. And that's the most important piece. Okay. There's lots of reasons behind this of why you would change some of the slight different structures. But just understand it's got to really make sense for both sides. Now, this one here is really kind of more of a message for our real estate experts that have been doing this for a while. I saw a couple shows of hands real quickly here as well. And really, they tend to get stuck in this 50-50 split scenario. And what happens is this. They may start to kind of provide discounts and really not providing a lot of confidence in regards to what their policies are. And my comment to you real estate experts is this: know your worth, okay? There is a lot that needs to be done. It's just like Susan that we shared that's running the restaurant. There is a lot that needs to be done in regards to property management, analysis. You are doing all of this work that is constant, okay? So understand, know your worth. But my comment to you as real estate experts, as you're going down this road, have a very clear and then underline bold, firm policy of what your split structure is, okay? Because this is really what you're striving for. Remember what your goals and objectives are, okay? And don't make exceptions that are going to impact what your investment goals are. Okay, so understand what your worth is. And I'm going to tell you, for a lot of experienced investors, we've all done this. I can raise my hands, both hands up really, really high, that I made exceptions at the very beginning. Definitely had some regrets from it because it did impact what my investment goals are and maybe giving a little bit too much more to our money partners. And so just be aware of this. So understand what the goals and the objectives are for both sides. It should create this kind of win-win scenario. So for you real estate experts that feel like they're kind of, beating their head up against the wall because they're struggling with this, know your policy, know your worth. And I'm going to share a quick little story, but honestly, anybody that I work with, especially that are new, that are actually wanting to negotiate, it's a non-starter discussion moving forward. I actually don't negotiate any of my terms whatsoever. This is what it is. And if it doesn't work out for you, then I want to wish you all the best. And so with that being said, and I've shared this before in my day number 1 session, there is lots of capital out there, lots of money. And so if it doesn't work out with this one particular partner, feel comfortable knowing there are other people that are out there. For you money partners, understand a lot of work, a lot of energy that comes along with this. And more importantly, you're trying to build a relationship that is going to create this win-win scenario, not just for the next 3 years or 5 years, hopefully for the next 20 years that you work closely together. And at the end of the day, you guys are all being successful together. Okay. So with that being said, some of the objectives that you have as a money partner. And again, these are some of the things that you should all be aware of, money partners. Okay. It gives you some of the time and financial freedom for yourself. Okay. And so with the objective of the money partners, they're also looking for trust. Okay. They want a trusting relationship from the real estate expert. They want to have trust in them. And that's why they're partnering with you. Okay. They're leveraging other people's time and energy. And that is the energy and effort from the real estate expert. So they don't have to do any of the work, like Susan as the chef. They don't have to do any of that stuff. Okay. In addition to that, they get to take advantage of present and also future cash flow that comes from this. So it's a great investment. And the best part, they're completely hands-free. They don't have to do anything. They're just putting in the capital to do this. But more importantly, you're hopefully going to get better returns on your investment than you're currently getting in your mutual funds or stocks. And this is one of the huge advantages. You're hands off. You're not doing any of the work. You're leveraging other people's experience and time. And at the end of the day, you're getting a great return on your investment. Now, this is always going to be a test, especially right now, but real estate investing is a great recession-proof investment, okay? And we're seeing some of those things starting to come to fruition now. And for some markets, this is going to be a true test. But with all these things that are going on with interest rates, and this is probably yet another webinar of some sort, is how is this going to impact the rental market? And I promise you that you will see some huge changes in the rental market as the demand goes up for there. The best part about this is you still have control, no different than kind of what a stock is. It's between you and a real estate expert, an individual. This is an asset that you own. And so something that is very tangible to you that you can see and touch and feel and understand. This can be a great investment where you have a lot more control of this than what you would see in a stock market where it can go up and down extremely quickly. Okay. So these are some of the objectives from the money partners and some of the advantages of why you would want this partnership. And then when we go to the real estate expert side of things, again, they get the time to do what they enjoy. They love this. They've been, for a lot of people, this is one of their focuses, is they're wanting to do this as a full-time career. And so they're working with you to help pursue some of their visions and some of their goals for themselves. In addition, as you know, all in Savvy Investor, it's all about building these great relations, commonalities, having a lot of fun, really engaging with other people. But this is something that they're all very, very passionate about. They have the ability to leverage other people's money because they can go and scale their business, which is a vision for them and an objective for them. But at the end of the day, they want success for their money partners as well. Of course, they want cash flow, present and future, because this is helping support them. That is one of their objectives. They're striving to do this to make this a success for themselves, their family, and for their partners as well. They are trying to create opportunities for their families. That was like me as well. It's the same scenario. And so with that being said, they're partnering with individuals to have that success. They get the recession protection. And then yet again, much more control because this is something that they oversee and that they manage. And at the end of the day, the key focus is together everyone achieves more. And that's the main principle. They're leveraging other people's time, other people's money. They both have mutually shared goals and outcome with vested interest to succeed. And that's the secret. Okay. So understand, for money partners, understand what is it that you're looking for from an investment, from a money partner. It's that trust, that credibility. But when your when your real estate expert is presenting you something, even after the split, are you comfortable with the returns that are projected for yourself? That's the really question you've got to ask for yourself. And that's it. It's not about what the real estate expert makes or this 50-50 split. Are you happy with the returns that you are getting after the split? That's the answer that you need to get. Okay. For real estate experts and money partners, well, again, it can be very hassle-free. It can be also very hands-on. For the money partner, it can be very hassle-free and hands-off. For the real estate expert, you're very hands-on and you're getting a chance to participate in projects with none of your money, which is fantastic. It just requires a lot more energy and effort, right? You get a chance to get quality properties with great return on investments by working together. Again, this whole kind of win-win scenario between both sides. And I'll tell you, this is the best way where most people scale their business is by working closer together, bringing their resources, and then really expanding as a team unit. Okay. So as we kind of conclude this presentation, wrapping up a little bit early. So to understand, participation should always be win-win. Shouldn't have this kind of feeling that one person is going to be more successful than the other. It's about winning together, and it's about being respectful of what everyone wants and comes to the table with. And by doing this and having open dialogue and discussing some of the roles and responsibilities and agreeing to a fair structure for both sides. I want to be clear, fair structure for the money partner and a very clear structure for the real estate expert. Real estate experts, we tend to cave a little bit. So be understanding, be clear and firm what your structure policy is. And hopefully your real estate or your money partner is willing to agree to that, but you should be firm. And I know for myself, if my money partner doesn't agree to the terms or policies that I have, unfortunately, I'm probably not going to work with that person. And that's just my policy because I am very firm. I don't want my goals to be hampered. I want my investors, my money partners to be successful. I want to be successful, and together we both achieve a lot more. So don't ever forget your goals. What are you trying to accomplish? And with that being said, if you do this and just kind of follow the steps that are just kind of highlighted there to help you structure the deal accordingly, it will make this whole process a lot easier for everybody. Okay. So with that being said, we are wrapping up today's discussion today, and we are going to be kind of concluding. So this is all about structuring your joint venture partnerships. Okay. So I want to thank you guys all so much for joining us for tonight's training session. Again, as tomorrow, we are going to be concluding the whole series as we pull everything together. And what we're going to be talking about tomorrow is building and creating that solid relationship. And this is after acquisition. So after you've acquired that property, after you found your ideal investor and you structured it appropriately, how do you manage this relationship after that acquisition? Because this is going to be really, really key. Having a good relationship with your money partner could create multiple new deals in the future if everything goes well. Again, this is another great session for tomorrow, and that's going to be taking place again 4 p.m. Pacific Standard Time right here on Savvy Investor's YouTube channel. So again, I want to be really clear that we are wrapping it all up for tomorrow. And for those that have not had the opportunity to watch some of the previous sessions, please stop in and watch some of the other previous sessions as well, and just play a little bit of catch up and try to come here live for tomorrow. Because like I said, there's a lot of great engagement, and this is where we start to wrap everything up and pull it all together. And again, if you guys haven't had the opportunity yet, and I thank you guys for your continued support on Savvy Investor, if you could also, again, please subscribe to our YouTube channel. Always appreciate the support as we continue to want to grow. And with that being said, thanks again for watching, and we'll see you guys all tomorrow at 4 p.m. Pacific Standard Time. Have a wonderful evening. Bye now.